The name's Bond. James Bond.
So you heard about the massive stock market crash in the wake of United States imposing tariffs on other countries. But what you may not have heard about is how those tariffs triggered a massive sell-off in the bond market in the United States. And that sell-off right now is making it extremely difficult for the United States to borrow money. The United States relies on debt to fund its operations. So let me break down what happened and how the United States economy is feeling the aftershocks. Historically, tariffs have almost always led to higher costs for imported goods.
Oh yeah!
If US consumers have to pay more for goods due to tariffs, they often reduce their spending on other products and services. Now, tariffs do not increase people's income. Instead, they often act like inflation by raising the prices of imported goods. As a result, consumers are forced to make sacrifices to maintain their spending levels, usually by purchasing fewer goods to avoid overspending. Now, this shift in consumer behavior, combined with broader financial and economic uncertainty, triggers a psychological reaction in the stock market. Many investors begin to believe that others will start selling their stocks early out of fear that reduced consumer spending will lead to lower corporate earnings. To avoid losses, these investors start selling their stocks also, hoping to do it before other investors sell and before the prices fall. Now, this herd mentality drives stock prices down, triggering more panic and more sell-off. And this snowball effect drives stock prices further down sharply. And if this occurs within a day or two, it's typically referred as a stock market crash. And this is precisely what happened after USA announced its tariffs. Along with the stock market crash, the tariffs also triggered a major sell-off in the United States bonds in the bond market, making it very hard for America to borrow money. Now, the US bond market is $55 trillion worth of market compared to $45 trillion worth of stock market. People like me and you can buy bonds, insurance companies can buy bonds, pension funds, mutual funds can buy bonds, and other foreign governments can buy US bonds. And people buy bonds because bonds offer a reliable source of income because of their regular yield payments or interest payments. United States government sells bonds to borrow money and finance government operations when their spending exceeds their revenue. And these bonds are called US Treasury bonds. Let's say I buy a 10-year US Treasury bond for $1,000 with a 5% yield. This $1,000, which is the price of the bond, is called the face value of the bond. The 5% yield is called coupon rate. Coupon rate is also called cost of borrowing money from the investors. In this case, US government has to pay 5% every year as an interest payment to the bond buyer. It means that every year for the next 10 years, I will get $50 from the government. This $50 is called coupon payment. The 10-year period is called the maturity period of the bond. You can think of maturity period as the loan period. The US government who issued the bond is called the issuer. At the end of the 10-year, which is the maturity period, the government will give me my $1,000 back. So basically, I loaned $1,000 to the US government because US government needed money. And in return, the government gave me $50 every year, which was the interest on the loan. And at the end of the loan period of 10 years, the government returned my $1,000. So this is how bonds work and how governments use them to borrow money. Now, in times of financial uncertainty, investors want to hold more cash. And how do they hold more cash? By selling their stocks and bonds. And they use that cash to support their businesses or buy necessary things whose prices have gone up because of the tariff. For example, because of tariffs, the price of goods will increase, and I will need more money to buy my weekly groceries. Tariffs will not make my income go up, but I have a 10-year US bond, which I bought 8 years ago for $1,000. So I can sell the bond to get some extra cash. But I'm still 2 years away from getting my $1,000 back from the government. But I need the money now so I can buy the overpriced groceries. So I sell my bond to get the cash. That is one reason people sell bonds. The other reason people sell bonds before the maturity period is similar to the psychology of the stock market. When you sell a bond early, others often interpret the selling as a sign of financial uncertainty or inflation. As a result, they may also sell their bonds to access cash. This creates a snowball effect, much like a stock market sell-off. Now, when bonds are sold in large quantities, their demand decreases. And when demand for something drops, its price goes down. So the bond that was originally bought for $1,000 might now be selling for only $900. For example, let's say I need more cash now to cover higher expenses, like buying overpriced groceries. I try to sell my bond, but others also need cash and are not offering $1,000 to buy my bond. They might only offer me $900 for the bond. And because I need cash, I sell it for $900 and bite the bullet. As more people sell their bonds to get cash, the price continues to fall and the cycle feeds on itself. This is how bond prices decrease during a sell-off. And this is exactly what happened in the US bond market after the tariffs were announced. Much the same way the governments of Japan and China have sold some of the US bonds to get cash, and they can use that cash to support their own domestic businesses. And let's not forget, China and Japan are the two of the largest holders of United States debt. So when a lot of people start selling their bonds, the demand for bond decreases. But the US government, they still need money. How can they borrow money if people keep selling their bonds and the demand is going down? Not only that, the bonds being sold are often purchased at a discount. For example, a $1,000 bond may be bought for $900. Now, if the United States government is offering bonds with a 5% yield for $1,000, why would anyone pay $1,000 to the United States government for the same 5% yield when they can buy a similar bond from someone else for $900? Investors have the option to buy bonds from me for $900 or from anyone else who is selling their bonds urgently to raise cash. So the demand for new US bonds will reduce. But US government still needs to borrow money. So what will it do? It will increase the yield on the new bonds to make them attractive to investors. Let's say United States increases the yield to 6%. So now United States will sell the bond for $1,000 and pay 6% interest payments on the bond. So the cost of borrowing goes up for United States government by 1%. And this is what happened in the bond market. The 10-year Treasury yield jumped from 3.9% to 4.5% in just 3 days. This 0.6% might not look like much, but in the bond world, it is like a tsunami of catastrophic proportions. Think of this increase as like your mortgage rate suddenly spiking overnight. But it's doubly bad for America because while the price of the bond decreased, the interest rate went up. This means that the United States can now borrow less money but will have to pay more in interest. You can think of it as someone having really bad credit. When someone has a really bad credit, they can only borrow a little amount of money but have to pay exorbitant amount of interest on the little amount they could borrow. United States has over $34 trillion in debt, and it borrows money to pay off all debt and the interest on the debt. It is similar to using one credit card to pay off the other credit card. America also borrows money to fund new spending. So the increase in United States Treasury bond yields mean that United States has to now pay more interest to borrow money. But where would that extra money to pay off higher interest payments come from? America already has $34 trillion of debt. It is already cash strapped. And the increased cost of borrowing is badly hurting America and is putting significant pressure on its economy. And this is why investors are really concerned because of the instability of United States debt. That said, while the United States is unlikely to default on its debt, the higher interest payments are creating a serious economic challenge for United States to borrow money. And this is why the entire US economy is feeling the aftershocks of the tariffs. Now, one reason US borrowing cost has shot up is because of the erosion of confidence in United States bonds as safe haven. Now, bonds have largely been viewed as a reliable source of income by many investors. But in the wake of these tariffs and trade wars, investors are starting to doubt the stability of US debt, and they are less willing to buy US Treasury bonds. Now, this has led to an increased borrowing cost because of higher yields for bonds and lower prices of the bonds. And let's not forget that United States still needs to borrow money to operate its finances. And this is the main reason United States has paused tariffs on many countries. Now, the big question is the trade war with China and its impact on the bond market. China right now holds around $775 billion worth of United States bonds. Can China sell all its United States bonds? Yes, China can sell all its United States bonds. What will China get when it sells its bonds? China will get United States dollars after selling the bonds. Why will it get United States dollars? Because the bonds are denominated in US dollars. And the investors who will buy bonds from China will pay in United States dollars because the interest payments for the bonds will go to them in dollars. What will China do with all the dollar? China will want to convert the dollar into its own currency, yuan. So China is going to flood the market with dollars, which will drive the value of dollar down because there are too many dollars in the market. China will sell the dollars in the foreign exchange market. Other investors, including other central banks who want to hold dollars for trade, will buy dollars from China and give China yuan and other currencies. In addition to driving the dollar value down, it will also strengthen the yuan, which is really bad for China because China relies on exports. And if the Chinese exports get expensive because of a stronger yuan, it will be really bad for Chinese economy. So no, China will not sell all its United States bonds. But it can happen, and it will be a mutually assured destruction for both China and United States. But it is highly unlikely to happen that China sells all its United States debt and bonds. The bond market will likely stay volatile, and the next time you hear about trade wars and tariffs, remember, it is not only about exports and manufacturing jobs. It is also about debt, interest payments, and trust in the global economy. And United States bond market is the foundation of global economy, but even foundations can crack. Cheers.
The name's Bond. James Bond.